if you happen to open your investment app this week, you probably had that feeling.
Oh, yeah.
That visceral urge to just close it immediately. Maybe throw your phone across the room.
And just pretend the last 48 hours didn't happen. You were not alone in that.
It really felt different this time. It wasn't just a bad day for tech. It felt like a total systems check on the whole economy.
It was. We saw red ink spilling everywhere. I mean, from the high-flying AI stocks all the way down to the things that are supposed to be safe.
Like gold bars.
Exactly, like gold bars. It was a proper whiplash moment.
So if you're sitting there looking at your portfolio thinking, what just happened?
Yeah.
Well, that's exactly what we're going to get into.
That is the right question to be asking. Because the confusion comes from the correlation. Usually, tech goes down, gold goes up.
The classic flight to safety.
Right. But this week, everything fell together.
Yeah.
And that's what we need to unpack.
That's our mission for this deep dive. We're not just going to read off stock prices. We're going to do a reality check and connect the dots between, well, some staggering spending announcements in Silicon Valley.
A very weird mechanical crash in commodities that caught everyone off guard.
And this huge reshaping of the workforce that's happening right under our noses.
It really is all one story, even if it looks like 5 different headlines. We're going to break it down into, I think, 3 main pillars.
Right.
First, the AI wobble. We have to talk about Oracle's debt and why Asian markets hit the brakes hard.
Then what?
Then, the liquidity crunch. Why gold, silver, and Bitcoin all just cratered at the same time. And finally, the corporate shuffle layoffs, ethics, and why a company like Disney is suddenly hiding its report card.
Okay, let's start with the big one, the AI wobble. We've been on this. This AI only goes up train for about 2 years now.
It's been the engine of the entire market.
But this week, it felt like the bill finally came due. And it started with a number from Oracle that I honestly had to read twice.
You and the rest of Wall Street. Oracle announced they plan to raise between $45 and $50 billion in 2026.
$50 billion. That's the GDP of a small country.
It is a staggering amount of money. And crucially, they're doing it with a mix of debt and equity.
So this isn't just a rainy day fund.
No, this is a war chest. This kind of capital deployment is. It's rare.
But what are they buying with it? Are they acquiring a competitor or something?
It's for plumbing.
Yeah.
It's all for cloud capacity. They're funding the physical infrastructure that their huge clients, we're talking AMD, Meta, NVIDIA, all rely on.
So Oracle is basically saying, we're going to be the construction crew for the AI revolution.
Exactly. We will pour the concrete, we will rack the servers, but the market...
The market hated it. The shares just took a nosedive. Why punish them for building what everyone wants?
It's the cost of admission. Investors got spooked by leverage, of course, but also dilution.
Okay, explain dilution.
Dilution is, well, it's like slicing a pizza. When Oracle issues new stock to raise cash, they're just slicing that company pizza into more pieces.
So my slice gets smaller.
Your slice gets thinner. And nobody likes a thinner slice of pizza.
Got it.
And the debt side is just as scary. It shows that staying relevant in AI isn't about clever code anymore. It's about capital. It's about having $50 billion to pour into silicon.
It's like the buy-in at the poker table just got so high that even the biggest players are starting to sweat.
Well said.
Yeah.
And speaking of big players sweating, we have to talk about the rumors around NVIDIA and OpenAI.
Right, that caused a panic. The idea that NVIDIA's big investment had stalled.
That was the headline. But we have to be precise here. NVIDIA's CEO, Jensen Huang, he came out and issued a correction.
So what's the real story?
He clarified it's not a $100 billion commitment. That was just a wild rumor. But he did say the stake would be large.
So the deal isn't dead. It's just not a blank check.
Exactly. But listen to what he focused on. He didn't talk about software. He kept pointing to the industry's reliance on TSMC, the chip manufacturer, and the desperate need for AI memory.
He's shifting the conversation from the magic of AI to the physical limits of making it happen.
Precisely. You can't have the magic without the manufacturing, and that supply chain is stretched to its breaking point. Which brings us to what we saw in Asia.
Because if you need chips, you're looking at South Korea. And their market didn't just stumble.
Yeah.
It fell down the stairs.
It was ugly. The Kospi index in South Korea dropped over 5%. So fast, in fact, that regulators had to trigger trading halts.
They literally had to pull the plug to stop the panic.
You know, it's serious when they do that. And the real irony is who led the drop.
Let me guess. Chip makers.
Samsung Electronics and SK Hynix. The very companies making the memory chips NVIDIA needs.
That makes no sense. If demand is through the roof, why are their stocks crashing?
It's what analysts are calling a re-rating. For 2 years, the strategy was simple. If it has AI in the name, buy it. Now investors are shifting. Now it's show me the returns. They realize that even if SK Hynix sells every chip they make, the cost to build the next factory is going to eat their cash flow for years.
The hype tax is expiring.
The hype tax is expiring. I like that. We're moving from the dreaming phase to the accounting phase.
And when companies start doing the accounting, they look at their biggest expense line.
People.
People.
And this is the darker side of the correction, the human cost. We're seeing a trend that researchers are calling AI washing.
AI washing. Is that like greenwashing, but for robots?
It's very similar. Greenwashing is pretending you're environmentally friendly. AI washing is when a company cites artificial intelligence as the reason they're cutting jobs.
So sorry, Bob, it's not that we overhired, it's just the algorithm is so good now.
That's the narrative. But the research suggests it's often a mask for other problems, bad planning, high interest rates, you name it. But pivoting to an AI future just sounds so much better to investors than we need to cut costs.
It's the ultimate corporate alibi. We're not broke, we're optimizing. And Amazon seems to be the poster child here.
They just announced another 16,000 job cuts.
On top of the huge cuts from October.
Exactly. But look at the fine print. Amazon insists this isn't a hiring freeze. They're still hiring in what they call strategic areas.
Which are data centers and machine learning, I assume?
Of course. It's a reshuffle. They're cutting middle management and logistics roles and pouring those salaries right back into the AI machinery.
So it's a direct displacement. They're swapping out the workforce.
Yes. And speaking of an automated future, there was a story this week that was, honestly a little unnerving. Have you heard about Moltbook?
I did. This feels like we've officially crossed into science fiction. It's a social network where humans aren't allowed.
That's essentially it. It's a platform designed for AI agents to talk to each other.
Okay, break that down for me. Why on earth does an AI need a Facebook profile?
Well, it's not for sharing vacation photos. It's for coordinating tasks. So an AI that's good at writing code can find another AI that's good at debugging, and they can collaborate on a project.
Without a human manager scheduling a single meeting.
No human in the loop at all, which sounds incredibly efficient, but
It's also completely opaque. How do we know what they're doing?
that's the black box problem on steroids. Researchers are flagging huge security risks. You lose the audit trail. You lose the ability to just say, stop.
It really makes you wonder, if the AIs have their own social network, where do the humans fit in?
It ties right back to the Amazon cuts. Who is the valued participant in the economy now? The human worker or the digital agent? It's a big question.
It's a heavy thought. Let's shift gears to something a bit more tangible.
Yeah.
Gold. Usually when stocks are crashing and robots are taking over, people buy gold.
It's Finance 101.
But this week, gold didn't just fail to go up, it tanked.
It plummeted. Both gold and silver had massive sell-offs. And you're right, fear normally drives gold up. But this drop wasn't emotional, it was mechanical. It was all about margin.
Okay, let's explain margin, because this is the key to the whole crash.
Think of it like a mortgage on a house. You put down a small deposit, that's your margin, to control a much bigger asset.
Right.
Well, this week, the exchange, the CME, they raised the deposit requirement. They said, this market is too wild. You need to put more cash down to keep your bets open.
So if you're a trader and you suddenly need more cash, but you don't have it.
You are forced to sell. It doesn't matter what you think the price will be tomorrow. You get a margin call, you have to sell the asset immediately to cover it.
And that forced selling drives the price down.
Which triggers more margin calls for other traders, which forces more selling. It's a liquidity spiral.
You're selling the lifeboats to pay for the ship.
Perfectly put. It's a cascade. And we saw a version of this on Main Street, too. Pawn shops and coin dealers saw a flood of people coming in to sell physical gold.
But that wasn't margin calls, was it?
No, that was profit-taking. People saw the price start to drop and thought, I better cash out now while it's still high.
So you had forced selling at the top and voluntary selling at the bottom. A perfect storm.
Yeah, the perfect storm. And then you have digital gold, Bitcoin.
Right. The crypto crowd always says Bitcoin is the hedge, that it's uncorrelated. It didn't look very uncorrelated this week.
No, it didn't. Bitcoin slid below $80,000, deep into the mid-70s, before it bounced a little.
Why, though? If it's the future of money, why does it crash with everything else?
Because right now, for the big money, it's still treated as a risk asset, just like a speculative tech stock. And in a moment of extreme stress, when everyone needs cash for those margin calls, You sell what's liquid.
You can sell crypto instantly, 24/7.
Exactly. So it gets sold first. It moved in lockstep with risky stocks, which really challenges that whole safe haven narrative. When the house is on fire, people still grab US dollars first.
Even oil took a hit, but that seems like it was for a completely different reason.
Yeah, oil slid about 5%, but that was all geopolitics. President Trump made a statement that Tehran was seriously talking.
Talking meaning de-escalation with Iran.
Right. The market had priced in a fear premium, worrying about a war disrupting supply. As soon as talks were mentioned, that premium just evaporated.
So we've got AI debt, commodity crashes, robot meetings. Let's look at how the big corporations are handling all this. Disney's earnings report was a really fascinating one.
Disney is a perfect case study. They actually beat their earnings estimates. Their streaming business saw operating income jump 72%.
That sounds incredible. Streaming is finally making money, so what's the problem?
It's about what they didn't say. Disney announced they will no longer be disclosing subscriber counts for Disney Plus and Hulu.
Wait, what? They just stopped counting. That used to be the only number anyone cared about.
It's a huge shift. For years, the story was growth at all costs. Just get more subs. Now Disney is saying they care more about the wallet than the head count.
From quantity to quality.
Right. They want profitable subscribers, not just more subscribers. But to investors, it feels like they're hiding something. It suggests the growth has stalled and the market is saturated.
The party's over, and now it's time to pay the rent.
Exactly. And speaking of paying the price, let's talk about Meta. They're in a big legal battle down in New Mexico.
This is a serious one.
It is. The allegations are that Facebook and Instagram enabled child exploitation, and not just by accident.
What do you mean?
The prosecution's argument is that it happened because of specific design choices Meta made to maximize user engagement.
They're putting the algorithm itself on trial.
That's the heart of it. Meta, of course, disputes this completely. They're pointing to all their investments in safety. But it highlights this growing legal risk for big tech. We're just a neutral platform. Defense is wearing thin.
It seems like ethics are finally becoming a major factor. We saw another strange example with Capgemini.
This was surprising. The consulting firm Capgemini is divesting its U.S. subsidiary because of scrutiny over its contracts supporting ICE, immigration, and customs enforcement, specifically their skip tracing activities.
Skip tracing.
Yeah.
They're basically using data to locate people.
In a corporate sense, yes. And Capgemini just walked away, citing a misalignment with group objectives. It is very rare to see a company leave a lucrative government contract because of reputational pressure.
Usually money talks loudest.
Here, reputation did. And speaking of money and politics, we have to touch on that Trump family crypto deal.
Right, World Liberty Financial. An Emirati-backed group bought a 49% stake for around $500 million.
And the timing was notable, right before the inauguration.
$500 million, foreign money, into a company linked to the president's family. That definitely raises some questions.
It does. Now, to be clear, both the White House and the company have issued statements saying there is absolutely no link between this investment and any U.S. policy decision.
We're just reporting the financial transaction.
Exactly. But from a market perspective, it's another layer of complexity, this web of global finance and politics.
And sticking with politics and finance, we have a new nominee for the Federal Reserve, Kevin Warsh.
Yes, President Trump's pick for the Fed.
And the market reaction was a little shaky.
Wobbly is a good word. See, analysts view Warsh as having a historically hawkish tilt.
And hawkish means he's more worried about inflation than growth, so he favors higher interest rates.
Generally, yes. And think about why that matters right now. If you're Oracle and you need to borrow $50 billion to build AI data centers,
You want cheap money, low interest rate.
you desperately want cheap money. If Warsh comes in and keeps rates high, that whole AI build-out gets way more expensive really fast.
So the AI boom is allergic to a hawkish Fed.
That's a great way to put it. Now, there are counter-arguments. People like Gary Cohn say Warsh would just return the Fed to traditional by-the-book banking. But the uncertainty alone was enough to give investors another reason to sell.
So let's just zoom out. We've got massive AI debts, commodity markets crashing on mechanical issues, layoffs disguised as innovation, and a potentially stricter Fed on the way.
It is a lot, but if you put it all together, I think the key word for the week is recalibration.
Recalibration. Unpack that for me.
Well, the AI hype is finally meeting the physical reality of debt and energy grids.
Okay.
The crypto and gold markets are meeting the mechanical reality of leverage and margin calls. And the workforce is meeting the harsh reality of automation.
It's like the rubber is finally meeting the road, and we're starting to smell the burning tires.
That's it exactly. And for you, the listener, the takeaway is crucial. This kind of volatility often signals a big shift, a changing of the guard from one economic phase to the next.
So the advice isn't to panic.
Definitely not. The advice is to watch the fundamentals. Ignore the flashy headlines and look at the balance sheets. Is this company actually making money? Can it pay its debts? The companies that focused on utility and profit are the ones that are going to survive this.
Look for the signal, not the noise. That is solid advice. As we wrap up, I want to leave you with one final thought. It's about Moltbook.
Yes. The social network for bots.
I can't stop thinking about it. We are watching a market that's being driven by algorithms reacting to margin calls. We are watching a workforce get reshuffled to make room for AI agents.
Right.
And now we know those AI agents are building their own networks to work with each other without us.
It leads to a pretty profound question.
If the producers are machines, the traders are machines, and the collaborators are machines, are we moving to an economy where the most active participants aren't even human?
And if that's the case, what happens to the human economy? Are we still the drivers, or are we just passengers hoping the car knows where it's going?
Something to think about. Maybe. Maybe just check your portfolio once today. Thanks for joining us for this deep dive.
We'll see you next time.